Good day and you're welcome. In this session, we're discussing the reversal of impairment. In the previous lecture, we did see that assets can lose value, and we saw how to account for those losses, which we term impairment. It is also possible that an asset which has been impaired, the conditions might change. As a result, it gains its value. In this case, we need to make a relevant adjustment to the carrying amount as well as the income statement. When we're going to do that, it is important to note that the increased carrying amount of the asset should not exceed the carrying amount that would have been recognized if no impairment recognized in our books. Now, there are two principles to note. The first one is that our asset has been impaired, and as a result, its carrying amount, it is also reflects that. I'll call it carrying amount impaired. We also need to take account that we need to know what is the carrying amount without impairment. I'll call it carrying amount without impairment. Then, when we're going to evaluate a reversal of impairment, we need to ensure that when we increase the asset value, it does not exceed the carrying amount without impairment. And if it does exceed that carrying amount without impairment, the excess reversal is not an impairment reversal. In fact, it is called a revaluation. To understand this concept better, let's look at an example. Pitch Limited is a large factory building. The building cost $320,000 6 years ago. And this asset was being depreciated at 4% per annum. Pitch Limited uses the cost model to record its PPE. 2 years ago, it was impaired to its recoverable amount of $231,000. And the useful life has not been changed. A change in economic conditions in the current year has resulted in the building's recoverable amount rising to $265,000 at year end. Show the accounting entries to record this change in the current year. To be able to answer this question, you need to have a timeline of events. Thus, we know that in year 0, and we have today when we're reporting. Please note that the asset was acquired 6 years ago. So between year 0 and today, we have 6 years. We're also told of an event 2 years ago, which means in year 4, because from year 4 to year 6, it is 2 years. Now, we know that the asset, when it was acquired 6 years ago, it was acquired for $320,000. So we need to recognize the asset at its cost. Then naturally, when we do have an asset, we're going to depreciate it. In this case, we're depreciating at 4% per annum. Please note this is the same as depreciating it over 25 years. I get the 25 years by saying 100% divided by 4%. Thus, if you're asked what is the depreciation per year, I would say 320,000 divided by 25 years. Depreciation per year is 12,800. Therefore, if I am to calculate the carrying amount without impairment, my carrying amount without impairment, I would say 320,000 minus the depreciation for 6 years. Remember that every year we're deducting 12,800. And we've used this asset for 6 years. Therefore, my depreciation for those 6 years, it is 76,800. 320 minus 26,800, it gives my correct carrying amount, which is 243,200. If we had not impaired this asset, our carrying amount without impairment is 243,200. Now, we need to understand the carrying amount with the impairment. We know that the impairment occurs 2 years ago, or it occurs in year 4. Therefore, to know the carrying amount on that date, I'll have to also perform a calculation. Remember that was starting with 320,000. And for the depreciation of the 4 years, I'll say 12,800 times 4, I'll be able to subtract 51,200. Therefore, the carrying amount at the end of year 4 is 320 minus 51,200. It is 268,000. 268,800. Now we are told that the asset was revalued on that date from that figure to 231. Clearly, this is an impairment. The asset went down by how much? 268,800 minus 231,000. We have an impairment here. So in year 4, we impaired by 37,800. Since we're accounting in the current year, which means since we're accounting in year 6, we need to understand what happened between year 4 and year 6. Now we know that the new carrying amount in year 4, it was determined to be 231,000. But between year 4 and year 6, the asset is being used for 2 years. So we need to calculate depreciation. It's important to note here the useful life was not changed. Therefore, out of the 25 years, we have already used 4 years. It means that we have to depreciate the remaining balance over the remainder of 21 years. Our new depreciation, therefore, can be calculated as 231,000 divided by 21 years, the remaining useful life. Our depreciation per year is now 11,000. So our new depreciation, I recognize it is 11,000 per year. So in year 5, we did depreciate 11,000. In year 6, we also depreciated 11,000. It means that the carrying amount in year 6, it is now 231,000 minus 11,000 minus 11,000. That is, it is now 209,000. This is what I called carrying amount with impairment. So we have the carrying amount with impairment in year 6 is 209,000. Except that in year 6, there was a change in economic conditions. The change in economic conditions resulted in us increasing the carrying amount to 265,000. Therefore, we need to make an adjustment for the carrying amount for our assets. That is, our carrying amount in payment is saying 209, but the recoverable amount, it is now higher. In other words, we no longer have any payment. That's what it means. So our recoverable amount here, it is now 265,000. We can see here that the carrying amount has been adjusted upwards by how much? 265 minus 209,000. This gives us 56,000 reversal of impairment. Now remember the principle. The principle says when you make an adjustment in the carrying amount, that is the revised carrying amount, should not exceed the historical carrying amount. The carrying amount after impairment, it must not exceed the carrying amount without impairment. Now, our carrying amount without impairment is 243, and our carrying amount with impairment or after a reversal of the impairment, it is now 265,000. Because the principle says you cannot reverse your asset beyond this figure, it means that the reversal of impairment, you calculate it. A fraction of it should go to the profit and loss account as a reversal of impairment. Then any other amount which reverses the figure above 243, it is accounted for as a revaluation. To record this in our books, we treat it like this. Well, first, I'll take our carrying amount with impairment. Our carrying amount with impairment, it took us to 209,000. Our carrying amount without impairment, it took us to 243,200. And we see here that our recoverable amount, it is now $265,000. Therefore, when we want to record this, the change from the carrying amount of payment to the old historical carrying amount, it is taken to the profit and loss account. In this case, therefore, we'll go and record 243,200 minus 209,000. We recognize 34,200. as a reversal of an impairment. That is, it is treated as an income in the profit and loss account. And then the increase from 243,200 to 265, it is recognized as a revaluation. 265 minus 243,200, we have 21,800. 21,800, it is taken as a revaluation to our other comprehensive income. That's to record this, I would go and say, go and debit or go and increase my asset, go and increase my PPE by the change from 209 to 265. 265 minus 209, my asset increased by 56,000. However, this asset increase, it is accounted in the books by showing a reversal of impairment, that is, we're going to recognize it as an income in the profit and loss account of 34,200. Then the other increase which we had, we go and credit it as a revaluation of 21,800. And with this, we've seen, therefore, how to record a reversal of impairment in our books. I would say thank you for attending. Looking forward to meet you in the next video. Goodbye.